It's Friday, September 27th, and this is, of course, the video log that takes $30,000 to $1,000,000 right here on this channel. I've been doing it for a while. It's been a year, over a year, and made some progress. So it's gone really well. And yeah, I'm gonna take you through the account right now. I'm gonna show you all the little trades and update you on the little things that have been going on. I have beat the market this week. Hallelujah. Thank you very much. By like 0.3%, but a win is a win. The account is down today by maybe $500 or so. I've made one large purchase, which it was a little bit impulsive because I was just so impressed by the potential value in the future. I didn't want to miss an opportunity. But other than that, today I'm going to talk about how to calculate risk when you're selling your call options, or at least figure out the risk when you're selling your call options. All right. So here we go, browser, and I'm sitting at 68,547. That would be the marked to market value of my account. And you can see the big players out here, right? Minus 26 on EXK, of course, dipping down with the rest of the precious metal sector. C-SPAN almost even, down $8. Apple down 167. And many people over here for Apple are saying that their gains have already been priced in to such a large degree. But I don't know if I buy that argument too much, because if we just look at a year back, when it was peaking out here, 232, I mean, the bad stuff wasn't priced in, but all this bad stuff, meaning like potential tariffs and all this and that, this extra cost and slowing China demand and whatnot, in my personal opinion, of course, it's not worth much because it's just me, but I don't think the downside being priced in is as great as the upside, which I don't think is fully priced in to the stock. I think that iPhone 11 sales are going to be phenomenal, and they're going to really surprise people on the upside. But anyways, that's Apple, so minus 167. I wish I had more money. Well, right now at 218, maybe I'm not going to go in or do any options plays, but I would like to accumulate much more Apple shares. Right now I have pre-sold 100 shares of those already through a call option, and I just basically hold 47 shares, which is not much at all. It's not going to buy me a Lambo. So actually I want an Austin. I want Austin Martin. So that's the dream right there. So anyway, scrolling down here, the Russian market's off a little bit. I need to accumulate, as I've been saying, the Russian market before December. I don't have many months left, and I still haven't made any purchases whatsoever. I have let it come down off of its $24 high, which is nice, and I'm waiting for it to get even lower before I can make some kind of move. I did sell a put option at 22. So if the Russian market reaches $22 by October 18th, then I will be purchasing it, which would be a bonus. So I'm almost cheering on for the Russian market to go down so I can buy in, because I want some of that fat dividend at the end of the year. You know what I'm saying? All right. So it's like over 6%. Actually, let me go back with the back button. And let's see, Russian market. And 6.75 according to the Robinhood website, which is not that inaccurate. Usually, sometimes they're a little bit off. All right, moving on down. This is taking way too long. Sorry about that. $24 on the negative with precious metals. And of course, the uranium sector is killing me as usual. Energy fuels down $63. Chemical down 54, which is not a big move considering the amount of cash I have invested into chemical. And URA, which is the uranium business ETF, down $46. Chemical 959 is still rebounding off of that low that I was talking about a long time ago now. I've been saying it as this was going down below $9 that I thought it would be rebounding. And I put my money where my mouth is. I sold a bunch of puts, gathered a bunch of stock, and now I have 900 shares of chemical stock, which is a lot. All right, that's $9,000 roughly at current market price. And not only that, but you'll be surprised to note that I have finally sold off, pre-sold all of those shares, which is very dangerous because now it leaves me with potentially no upside position for chemical if it were to go above $11 or $12. The highest call I have sold, I think, is about $12 right here for January 17th, which means that if the price reaches $10 and then $11, that's it. I mean, I only have 100 shares that carry me on to $12, and beyond that, I'm fried. So I'm counting on chemical to stay leveled and not exceed this $12 mark right here. If it does, fine, I will have made some money. But if it goes a lot higher than that, not fine, because I'll be missing out on a huge opportunity to make a lot of cash. So moving on to the covered call options. Now let's take a real life example. Someone who publicly commented, all right, on one of my videos, and we'll take a look at Disney. Okay, so looking at Disney, the individual in question who posted a public comment, I'm not just putting it on blast, anyone can read this. He has bought, according to him, Disney shares at $136. Now, Disney's been on the downslope, which is bad for his immediate returns. Yeah. So, what do we do from here? So he has the opportunity to sell some calls, which would not be a bad idea. Now, what would I personally do if it was me, not you? This is not financial advice, of course. Make sure you do your own diligence, consult your own financial professionals if you know some, and if you don't, please don't take my advice on anything. You'll have to make your own decisions. Of course, you're responsible for your own trades and financial moves as an individual. And if you're not over 18, then your parents are. Okay, I'm not, so don't come after me. So anyway, so 136, and now it's obviously at 130. Now, what I would do if I was personally in the situation is I would probably buy more if I believed in this company. And well, it's a really nice steady uptrend here in the last 5 years. And for many reasons, I mean, they seem to be doing well. They purchased Marvel, and now they have their service that's going to compete with Apple and Netflix and everything else, so and Hulu and Amazon. So that's all good and gravy. Their content looks to be solid. But I don't really know this company very well. I haven't gone through its balance sheet. But if I did, and I was certain that the company is not going to go bankrupt, and it does actually give a nice 1.44% dividend, then what I would do here is, well, first of all, I wouldn't buy at this level. But if I did for some odd reason, then I would average down at this point right now, or even wait for it to drop lower, and I would average down. I think the drop is a little bit too steep to be selling calls now. I would probably sell a call as soon as, if I thought I wanted to collect income off of this company, I would sell a call as soon as I buy the stock, right? So at 136, sell calls at like 140 or whatever, start collecting premium while I wait for the price to appreciate or depreciate. At this point, you could theoretically and in practicality sell calls against your shares. But if we look at the, let's say, October 4th, which is in a week, market here for the options, for the call options, if I were to sell a call option at my buy price of 136, I would only be collecting $12 for my shares. And that's a lot of shares. Okay, so in just, in order to sell just one call, that's 100 shares, which is what, $13,000, $13,600 for $12, right? That's not a very good payout. One trick you guys can do, one maneuver that you could try out, or that I could try out if I wanted to sell some calls and go out for a further duration, right? Because now what's going to happen is that the price will have more time to swing up and down wildly, especially for the options that are a little bit way out of the money, right? Like this. Well, not way out of the money, but more out of the money. So it will give time for the price to make a decent move one way or the other. So that's obviously priced into the market. Okay, this wilder swing price is priced into the market. So you could be collecting premium off of a larger duration option. And now if you divide that by 3, you'll see that the price per week that I'm getting is more than $12. All right, so 1 week, 2 week, 3 weeks. So I'll divide this premium by 3, okay, which will give me $21, which is higher than I would get if I were to sell for just 1 week. Okay, the 136 call is $12, right? 21 is higher than 12, so I get $21 per week. Now this function obviously works up until an extent. At some point, the difference in price is not large enough to account for the movement, so it doesn't get priced like that anymore. So let's, for example, take the December 20th, all right, and I can't do 136 anymore. So let's say December 20th, 393. Now I would expect November 15th to be a lot less per week, all right. So it's 300. All right. So I don't know how to, I don't want to do the calculation right now, but it's probably less. All right. Because it's not close enough. It's too close to the strike price given the time period. And so it won't take as much of an effect. So the longer you wait, right, the more chance the price has to move in one direction or the other. And that will give you a higher premium and obviously more risk. There's very little risk in doing the October 4th option, right? Very little risk that the price will actually get up to 136. It's possible to do it in a week and surpass 136, but the chances are not very high. All right, not very high. So I believe the right Greek for this is the gamma over here, 0350. Let's take a look at October 18th. You can see the gamma is increased, 0436. Now don't worry about the Greek so much, just try to figure out the numbers on your own. They're kind of just little simplifications for professional option traders, for them to be able to tell the difference between the valuations of each different stock very quickly and easily. But I recommend doing this on your own. Now, what I say by calculating or judging whether or not something is worth it is that a good payment, right, for you or for me in this case, right? Is that a good enough payment for the money that I have invested? Is $12 per week a good earning, right? Is that worth the risk of missing out on potential gains over $36? $136, these $12, right? And for me, the answer would be no, okay, personally. But if it was $21 per week, right, the answer would be yes. So you would have to figure out how much, you have to figure out all the different scenarios and then figure out whether or not that's worth it for you and whether or not you're going to be okay with that happening. All right, so am I going to be okay if the price, let's go to the October 4th one. If the price reaches 136 and goes above 136, well, no, I'm not going to be okay because I'm going to be selling my stocks at the cost, and I'm going to be collecting like $12 premium. I mean, for 1 week, $12 for all that money for 13,000 or some dollars worth of money. That's just not enough, right? So now I'm not okay with that scenario, right? The other scenario obviously is the market, the price keeps falling down, and then we're not collecting enough premium for it, and I still might not be okay with just $12 if the price goes down, right, per week. So with $21 per week or more, then you know it might start looking better. So you have to try to figure out, what your tolerance is, what your risk tolerance is, how much you're willing to get paid for the time that you're spending in a specific stock or contract, and then make a judgment based on that assessment. It's going to be different for everyone. Maybe you're more okay with getting paid $28 for that week, but risk having a loss of $200, right? If the price reaches 134, maybe you're going to be okay with that, right? Maybe you think it's going to go down further and you're just looking to exit your position and you want to get as much premium as you can for your quote unquote mistake, which isn't necessarily a mistake. You just bought some shares. And so you're looking at this 131 call option. You're saying, well, if it's going to go down this week, I might as well collect $111 from my trouble. That could be your viewpoint. The downside, of course, is the upside of the stock. So if the stock goes up, then you're at a loss of $500. You see what I mean? So yes, you collect that 100, but you still have another 400 worth of losses that you have to contend with. So obviously, there's risk in everything. You're not gonna find a scenario where you have no risk, right? It's always going to be some kind of a downside to your scenario. Things could go wrong, and you have to consider that, and you make a decision. Put yourself in that situation. Like, place yourself in the situation of, all these different scenarios. Where the price could be, by how much, and whether or not you're going to be okay with it, right? And you should be doing that. I mean, I should be doing that, but everyone should be doing that. Before you initiate any position, before you buy any stock, you should think and say, all right, am I going to be okay if this stock drops 90% in a week? How am I going to react, right? What am I going to do? Plan ahead of time. What am I going to do if the stock goes up 100%, 200%, 300% in a week? Am I going to sell once it goes up 10%? Why? Why wouldn't I let it run further? Is it a very extremely large company that cannot have wild swings like that? In this case, maybe yes, maybe you're justified. Maybe you should sell after 10%. But what if the company is an exploration company of some sort and they hit a big discovery and people are trying to find out how much discovery is worth? I mean, would you sell a 10% gain? No, you would let it run, especially if the discovery is extremely large. Right, so you have to know your parameters. Like, whenever you're putting money to work somewhere, and investing in something, you have to figure out what your exit is going to be, if there's going to be an exit. Is it a lifelong company? Or are you going to hold it until you die? Right, like Warren buys some companies and he'll never sell them. He doesn't want to do it. Warren meaning Warren Buffett, right? So is it going to be a lifelong company? Is it a fund? Is it a fund that you'll never sell and just collect dividends from for the rest of your life? So you want to come into an investment with a plan. Okay, so I've been blabbering a lot. Try to explain some stuff here on the call options and also your mentality when it comes to calculating calls and making a judgment, and also pre-planning your entry and exit strategy for every single purchase you buy. I think it's really, really crucial. Like, I don't do this, but you should, because you're better than me. You should write this stuff down. Like, find pick the stock that you're trying to invest in or a specific contract or configuration, and write down what are your parameters of being okay with it. It will give you really, really good clarity when you're in the moment. Because when the shit hits the fan, right, and when stuff starts moving, then your system might start reacting. You might get nervous. You might, who knows, you might go crazy. But if you have that sheet, if you have the words written down that tell you, okay, if this happens, this is how I'm going to react. If you have everything pre-planned, then you have parameters that you can move within, and it makes you make a much more clear decision in the moment. So that's my advice there um, for all your investors. And like I said, like there's just stuff that I've learned. Obviously, I'm not a huge pro. I'm not like a market busting Wall Street, Goldman Sachs, market maker type of pro. So I'm just doing my own investments, just trying to run my own portfolios and my own accounts, and just been doing it for a really, really long time, and just trying to learn as I go and get better and build some wealth. All right. So hopefully you're doing better than me. I wanna know what you guys are doing. Actually, honestly, like I always mention, the reason I started this video log, most of it is so I can find out what other people are doing. I always browse at, look for channels and other people's accounts and try to get some ideas and gain a different perspective on the market and get a feel for everybody's thinking about what's going on in different asset classes and equities and so forth. So, all right, I think I'm gonna end it right there. It's been a really long episode. It's been a pleasure explaining on this, and make another video probably on Monday. All right, peace out.